Hi everyone and welcome to Lean Finance. What exactly is an index and an ETF and how are both related to each other? These questions I will answer in this video. My name is Sven and this channel is about finance, investing and money. The goal is to show you that personal finances don't need to be complicated. So let's go with this next video. Before we talk about ETFs, we need to clarify what an index is, because both are highly related to each other. An index is used to group shares based on precisely defined criteria and reflects the development of these shares over a certain period of time. The grouping criteria can be related to industries, regions, asset classes and other factors. The MSCI World Index, for example, groups the 1,600 companies with the highest stock market value worldwide, whereas the German DAX just contains the 30 most valuable companies in Germany. There are millions of indices existing to better monitor the performance of defined markets. In most cases, indices are offered and calculated by large stock exchanges, independent index providers or rating agencies. But you cannot directly invest into an index as an investor. For this purpose, we need an ETF. ETF stands for Exchange Traded Funds and are index funds which can be traded at the stock market. An ETF copies an index like the MSCI World Index or the DAX 30 by investing in all companies of the underlying index. As soon as new companies are added to the index, the ETF also includes them in its fund. And the same way, it excludes stocks that are removed from the index. These processes happen fully automatically and without the analysis of a fund manager or actions of the investor. The aim of an ETF is to achieve the same return as the index it is tracking. So if, for example, the MSCI World Index rises by 2%, the value of an MSCI World ETF also goes up by around 2%. If the value of the index falls, the ETF also decreases by the same amount. We can differ between two types of ETFs when it comes to dividends: accumulating or distributing ETFs. If a company generates profit, this profit might be distributed to the shareholders in the form of a dividend. But as an investor, you don't own directly the share of the company. Therefore, the dividend goes to the ETF fund. The fund can then transmit the dividends to its investors' bank accounts, which is the definition of a distributing ETF. By contrast, the dividends can also stay in the fund and get automatically reinvested into the index for its investors. This is then an accumulating ETF. This difference gets interesting when we will talk about taxation in one of the future videos. ETFs are commonly used when following a passive investing strategy at the stock market. In my last video, I already explained the passive investing strategy and its benefits. I will link this video for you here at the top and in the description below. An ETF mirrors a lot of the benefits of the passive investing strategy. By investing in an ETF, you can maximize the diversification of your portfolio, because by investing in an index, you automatically distribute the risk to several companies. Another advantage is the transparency of an ETF. As an investor, you always know exactly which companies or assets you are investing in, because the fund follows clear rules which are automatically executed by a computer. In an active investing fund, you don't know exactly what the investment managers behind the fund are doing with your money. This is also why ETFs are a lot cheaper than active investment funds. There are no fund managers to be paid, so that ETFs have just yearly fees of around 0.1 to 0.5% of the invested amount. An active investment fund has yearly fees of around 1.5 or even above 2%, which is a significant difference. On top, ETFs are liquid, so that as an investor you can sell them at any time at the stock market. Combined with the buy and hold approach of the passive investing strategy, ETFs are a great product for investing in the stock market. ETFs are cheap, easy to understand, liquid, and let you participate in the development of an index. I hope this video helped you to understand stock market indices and ETFs better, so that you can start using them for your own investments. Feel free to subscribe to stay on board for the next video and to leave a like to support this channel. I'm looking forward to getting your feedback in the comments below, and preparing the next video for you. So see you soon and have a great day.